Okay, this video tutorial looks at the mathematical strand of investments, and more specifically, we're going to focus our understanding on tax. So, what is tax? Well, essentially, tax is something that you are required to pay whenever you earn interest from an investment account. Okay, so the rate of tax you pay is basically dependent on your annual income. So, for example, if the money that you earn throughout the year from all of your income, all of your methods of income, falls between 18,000 and 37,000, or 18,201 and 37,000, then your percent that you're going to pay for tax is 19%. So basically, 19 cents for every dollar that you earn is going to be for tax. If you are lucky enough to earn more than that, and you earn somewhere between $80,001 and $180,000 per year, then you go up a tax bracket or a couple of tax brackets and you end up at 37%, which is this basically means the amount of cents for every dollar you earn. Okay, so in our first example, you'd pay 19 cents for every dollar that you earn. In our second example, you'd pay 37 cents for every dollar that you earn. And here's an example question where we look at tax and tax rates. Basically, we're trying to work out how much tax somebody would pay based on their income. So the example says Zoe has a salary of $45,000. Okay, so straight away we can see that Zoe is going to be in this bracket here, right? Because 45,000 sits between 37,001 and 80,000. So she sits in there, and she receives an $1,200 interest from an investment account. The first part is how much tax does Zoe pay on the interest? All right. So we're looking at question A. We've got the answer over here. It says the total income. So basically, we need to add her yearly salary plus the interest. We've done that, and we've got 46,200. For this total income, you can see she's between 37,001 and 80,000. So the tax rate is going to be 32.5%, all right, which we've highlighted with a red arrow anyway. And therefore, we basically work out 32.5% of the interest that she's earned. All right, so that's what we're doing in this step. And we've worked out that she has to pay $390 in tax. So that's the tax she has to pay. The second part of the question says calculate the after-tax return. Now, the after-tax return is basically the interest, or the interest she receives from the account minus the tax. So you can see here she got $1,200 from the account. She had to pay $390 in tax. All right, so we take that away, and that gives us a total of $810. All right. We're going to go through. I'm going to give you a practice question, which is very similar to this on the next slide. Please feel free to pause the video when you get to that slide. Have a crack. If you think you've got the correct answer, continue to the end, and we'll go through. So as stated, here is the practice question. It's about Mr. Keogh. He's got a salary of $85,000 per year, lucky him, and he receives $2,500 interest from an investment account. So how much does he have to pay? Please feel free to pause the video here, and once you think you've got the correct answer, continue the video and we'll see how you went. Okay, so let's see how you went. So straight away we can see that Mr. Keogh has a salary of $85,000 and he receives $2,500 of interest from the investment account. So first thing we want to do is we want to add his salary to the interest he gets, all right, which is therefore going to be $87,500. Okay, he's got, put our dollars in here. We know that this is in the 37% tax bracket. Okay, so the tax that he has to pay is going to be, so the tax is equal to 0.37 multiplied by the interest that he found, or that he was able to accumulate. And if we just get out our calculator, and work that out, that gives us a tax that he has to pay of $925. So his after-tax return is basically going to be his interest minus his tax, which was $925, which is going to give him a tax return of $1,575.